What if you knew the exact moment the real estate market was about to crash? Would you have done anything differently? It's the billion-dollar question that has haunted many since the real estate crash. A question that underscores the importance of understanding market dynamics, the subtle indicators that signal a shift, and the necessity of foresight in the world of real estate. Imagine having a crystal ball that could predict the rise and fall of property prices, the ebb and flow of demand and supply. Now, what if we told you that such a crystal ball exists, not in the form of a magical artifact, but in the form of knowledge, experience, and wisdom? Intriguing, isn't it? Today, we will journey together into the mind of a billionaire visionary, a real estate tycoon who saw the signs, read the tea leaves, and predicted the crash. What does he know that others didn't? In today's video, we'll delve into the mind of a real estate tycoon who saw it all coming. Every disaster has its warning signs. The real estate crash was no different. Let's take a journey back in time. Imagine a world of skyrocketing property values, easy credit, and a belief that the good times would roll on indefinitely. This was the landscape just before the crash, a bubble primed to burst. One of the main catalysts of the crash was the rise of subprime mortgages. These were loans given to buyers with poor credit histories, or simply put, those who were less likely to repay. Lenders, in their quest for quick profits, ignored the risks, driving a surge in homeownership. The problem? Many of these new homeowners were ill-prepared to handle their mortgages, especially when interest rates started to climb. Next, let's talk about irresponsible lending. Lenders were all too eager to issue mortgages, often without proper checks and balances. They gambled on the continued rise of property values, believing they could always sell a defaulted property for a profit. But when the property bubble burst, these lenders were left holding the bag. Lastly, we can't overlook the overvaluation of properties. In the years leading up to the crash, property values were inflated far beyond their real worth. This was fueled by rampant speculation, and a belief that property prices could only go up. When reality hit, and prices started to fall, many homeowners found themselves with properties worth less than their outstanding mortgages, leading to a wave of defaults and foreclosures. These factors, though seemingly insignificant individually, collectively snowballed into the avalanche that was the real estate crash. They created a perfect storm of economic instability that led to the downfall of major financial institutions and a recession that affected millions of people worldwide. But as we'll see in the next part of our journey, the crash also offered valuable lessons and opportunities for those willing to learn. These factors, though seemingly insignificant individually, collectively snowballed into the avalanche that was the real estate crash. One thing leads to another, and before we know it, we're in the middle of a crisis. That's the essence of the domino effect. It's about cause and effect, action and reaction. And in the case of the real estate crash, this effect was in full force. Picture this: a series of dominoes lined up, each representing a catalyst that contributed to the crash. The first domino perhaps could be the rise of subprime lending. Risky loans given to borrowers with poor credit history, driven by the belief that property values would keep going up. When the borrowers defaulted, that first domino fell. The fall of the first domino set off a chain reaction. The next domino represented the financial institutions. Many of these institutions had invested heavily in these risky loans, believing in the security of real estate. But as more and more borrowers defaulted, the financial institutions started feeling the pinch. Their domino tumbled next. Then there's the domino representing government policies. The government, in its bid to make housing affordable for everyone, encouraged these risky loans. But when the defaults started piling up, the government found itself in a tricky situation. Their domino was the next to fall. And with each falling domino, the impact grew larger, the consequences more severe. Banks started failing, the stock market plummeted, unemployment rates soared. And the real estate market, once a beacon of prosperity and growth, was now a symbol of financial ruin. But here's the thing about the domino effect. It's not just about the fall, it's about the setup. It's about understanding why the dominoes were lined up the way they were, and how we can prevent them from toppling over again. Because at the end of the day, the domino effect isn't just a concept, it's a warning, a reminder that every action has a reaction, and that in the world of real estate, these reactions can have far-reaching consequences. The domino effect was in full swing, and the real estate market was on a collision course with disaster. With the benefit of hindsight, everything seems clear. However, foresight is the true game changer. When the real estate bubble burst, it seemed as though the world had been taken by surprise. But there were those who saw the storm brewing on the horizon. Among them was our visionary, a seasoned billionaire with an uncanny knack for reading the market's undercurrents. This visionary didn't have a crystal ball. No, their foresight was rooted in a deep understanding of the market, a keen eye for detail, and an unshakable belief in the power of patterns. They recognized that real estate wasn't just about bricks and mortar, but about people, their aspirations, their fears, and their capacity for risk. When others were caught in the euphoria of skyrocketing home prices, our visionary was looking at the fundamentals. They saw a market fueled by speculation, with property values unhinged from their real worth. They saw an economy over-reliant on the health of one sector. They saw a wave of risky mortgages, a ticking time bomb waiting to explode. But having foresight is only half the battle, acting on it is another. Our visionary harnessed their insights, making strategic decisions that cushioned the impact of the crash. They pulled back from overvalued markets, diversified their investments, and positioned themselves to buy when prices hit rock bottom. Their approach wasn't about avoiding risk altogether, but managing it wisely. They understood that in every crisis there's an opportunity. The real estate crash was no exception. Amid the chaos and confusion, they saw a chance to reshape the market, to build a more sustainable and resilient industry. Our visionary's tale is a testament to the power of foresight. It's a reminder that in the unpredictable world of real estate, it's not enough to simply react. To thrive, you need to anticipate, to plan, and to act decisively. While others were blindsided, our visionary saw the storm brewing on the horizon. History teaches us valuable lessons if only we're willing to learn. Lessons from the real estate crash are not just about facts and figures. They're about understanding the heart and soul of the market itself. The crash was a stark reminder that the real estate market is a living, breathing entity, susceptible to the same ebbs and flows as any other market. It's about recognizing that the real estate market is not an isolated sphere, but deeply interwoven with the global economy. One of the key lessons from the crash is the importance of understanding market dynamics. An intimate knowledge of these dynamics, which includes factors like interest rates, inflation, and economic growth, is crucial. These elements don't just influence prices, they shape the entire landscape. So it's not enough to simply keep an eye on the housing market. We must widen our perspective and consider the broader economic context. Recognizing early warning signs is another invaluable lesson. Warning signs are like whispers, easy to miss unless you're listening closely. They might come in the form of sudden changes in buyer behavior, shifts in lending practices, or fluctuations in property values. The ability to spot these signs early is akin to having a sixth sense. It gives you a head start, and in the world of real estate, time is money. And then there's strategic decision-making, the ability to make sound judgments even in the face of uncertainty. This skill is what separates the good from the great. It's about knowing when to hold back and when to forge ahead, when to buy and when to sell. It's about being able to adapt to changing circumstances and make the best out of any situation. These lessons are not just theoretical concepts, they're practical tools that can help us navigate the unpredictable waters of the real estate market. They serve as a compass, guiding us through the complexities and uncertainties that are part and parcel of the industry. The real estate crash was a harsh teacher, but the lessons it taught are priceless. The crash changed the world of real estate, but it also opened up new opportunities. It shook the foundations, yes, but it also cleared the ground for fresh and innovative approaches. Now, more than ever, adaptability is a realtor's strongest asset. The ability to anticipate change, to shift gears swiftly, and to pivot with the market's ebb and flow is what separates the successful from the struggling. Remember, the market is a living, breathing entity. It morphs, it evolves, and so must we. The crash taught us that clinging to outdated strategies is a surefire path to obsolescence. It underscored the importance of strategic planning, of having a proactive rather than a reactive approach. It highlighted the value of foresight, of reading between the market lines, and of understanding the subtle signals that whisper of change. The real estate crash was a wake-up call for many. For those willing to learn, it was also a stepping stone to greater success.